Good morning, this is Marc Walton and Fotis Papatheofanous. This is the recorded highlights of the investment committee meeting that we hold on a Monday morning, where we are evaluating what is happening around the world in the financial markets and then how that helps us to hone in, for example with Forex, on which currency pairs we aim to concentrate on for the days and weeks ahead. At the end of this brief presentation by Fotis, we will introduce you to one of our Pro Trader course clients, Judith. Judith joined us last week. Already she is showing great improvement in her knowledge and her trading abilities, and Judith is going to do a short presentation for us with her fundamental analysis, and then we'll have a little discussion with Judith about some of the issues and how she's finding the course so far. So I'm going to hand you over now to managing partner Fotis Papatheofanous. Good morning, Fotis.
Good morning, Mark. Let me begin by the United States dollar. One of the key factors that is affecting the dollar right now is sentiment. Sentiment at the moment is one of the most important catalysts, and we can also tell from this chart that shows the Dow Jones 30 that sentiment right now is at really high levels. The environment is in general terms very positive. Interest rates have a stable outlook. Of course, they are expected to rise at some point in the future, perhaps around mid-2015, but at the moment, Yellen seems to be pretty dovish, and the Fed doesn't look that they are going to put the recovery of the US economy at jeopardy by raising interest rates too soon. Now, one of the key things I'm looking at when I'm trading currencies is intermarket relationships. I'm talking about the US dollar, and you can see here that I have the Dow Jones chart on my screen. I use the Dow Jones, I use the equity indices as a measure to understand the sentiment in the markets. So what I can see right now, that the sentiment is very high. And let me show you, Mark, another chart that in my opinion is the most important for me at the moment, which is the VIX. Now I have gone here to Yahoo Finance, and you can see the VIX. The VIX measures implied volatility. It is different than historical volatility in a sense that it measures expectations about the future. And right now, the price of the VIX is around 10. This number is very low. This is, I believe it is at 7-year lows. So, what we have is very strong equities, combined together with a very low reading of the VIX. And you can see also from the press that sentiment indicators, they are located at the moment are at bullish extremes.
Also, just interject there, Fotis, the VIX is often known as the fear index. So it's an indication of the investor sentiment at the moment. And I'm right in saying that with the VIX being so low, that means that the fear element is low, and therefore people are very bullish as far as the stock market is concerned. Is that correct?
Yes, you are absolutely correct. People are very bullish at the moment. We are in a stage of the stock market that nothing seems to go wrong, and it is exactly at these levels of the VIX where you must be careful. If I do an historical analysis and measure where the price of the equities was and where the VIX was before we had a major turn in the market or a major negative outcome, you will notice that always before a major storm, let's call it this way, VIX was at extreme low levels. Now, this doesn't mean that tomorrow or the next week we are going to have a major turn in the market. We don't know yet when exactly this is going to happen. But it is good for us to know where we are standing when it comes to sentiment, so we will prepare our portfolio and our positions accordingly. Let me now finally go back to the Euro chart So what we have discussed so far is that equities is at record highs, VIX is at record lows. This is positive for the US dollar, and you can see that as equities have moved up, euro has come down. Lately we had a bit of choppiness because of the news coming out last Thursday from ECB, and then we had the NFP on Friday. But I believe this pair will be influenced a lot by two things. One is sentiment, and we will identify this by looking at equities and the VIX. And there is also fiscal policy. This is what it is decided by Draghi. Last Thursday he unleashed a bazooka of 400 billion. This is very important. And of course he lowered interest rates. Now many people are saying that by lowering interest rates this is negative for the euro, and I agree, in theory it is fundamentally negative. But we have to put everything into context. When the Fed or Japan, but especially the Fed, were announcing their quantitative easing program and they were throwing money into the economy, they were doing this because they were afraid that the market would collapse, and they wanted to offer liquidity to the markets so they would avoid a catastrophe. In this case, this is not the same thing happening for the European markets. Such a scenario doesn't exist at the moment, and what they want to achieve is to raise the inflation. Inflation is moving down. This is very bad because they don't want to move to a deflation regime, and they are trying to revive the loan market so inflation picks up a little bit. So in the long run, I believe what Draghi did will prove very good for the euro. Now, what is another important date to look at is the 18th of June, where we have the interest rate decision by the Fed. I don't expect much to change, but it is important to look at the interviews after the announcement, so we see what kind of language they use, if they still sound hawkish, if they sound a bit dovish. So we will be monitoring this. Let me move to another currency that also is influenced from what happens in the United States, and it's all about sentiment as well. And this is the Japanese yen. Now, from Sunday moving to Monday, we had Tokyo Open, and we had the first quarter GDP released, which was good for the yen. This is why you see that the dollar is finding a little bit of resistance over here. What will affect this particular currency is, of course, what happens in the United States, what happens with the equity markets, what happens with the VIX, and also it is important to monitor the statements that come out from Bank of Japan officials. Do they sound less dovish? Do they think that the economy is doing good and they start adopting a different language? It remains to be seen. For me, this is a very good pair in a sense that I use it for risk-on, risk-off setups. If we see a big change in sentiment in the equities, as I was showing you before, I will use the dollar yen to trade. If there is a negative sentiment, I will quickly move on to buy yen. This is something that we explain in the course. There is another currency that is not about sentiment, but it's all about interest rate expectations, and this is the British pound. Here we have a chart. You can see that since late 2013 we had a rally in the pound. The reason this happened is because the economy started doing better and the expectations about an interest rate hike were higher. What happened here, we reached this top and we had a little bit of a retracement, is because the chairman, Chancellor Carney, tried to downplay a hiking in interest rates. fundamentally nothing has changed, but I think they are afraid that if they have a very hawkish tone and they assure people that they're going to hike interest rates, this will drive the British pound too high, and this might affect the housing market. It might affect the economy. So they are very careful with this, so they tried to downplay what the UK economy has achieved. Now, at the moment, for the pound, we are at a critical juncture. Are they going to continue adopting a similar dovish language that they adopted the last time? What I mean is, are they going to say something like, oh, you know what, yes, the economy is doing well, but the interest rates will be stable. They will not change for the moment. We'll have to see and evaluate. If they say something like this, this will be negative for the pound. If they sound a little bit more hawkish, this will help the pound because, as I said, expectations, of course, is for interest rates to rise. So we will keep an eye on economic data coming out of the UK, and on the 10th of June, we have the manufacturing production, and on the 11th, we have jobless claims and unemployment from the UK. These are important because it will give us a clue about what will happen with interest rates. And right now, I will say this again one last time, interest rates is the driving catalyst behind developments in the British pound. There is another currency that has a very similar outlook as the British pound, and this is the New Zealand dollar. Now, this is a traditional chart from the New Zealand dollar, and you can see that the Bank of New Zealand started hiking for quite some time now. You can see this has been already priced in the price. What happens lately, however, is a change in tone, a change in sentiment. Even if they raise interest rates, what it is more important is expectations about the future. Are they going to continue to raise interest rates? Are they going to adopt a stable interest rate policy for quite some time? This is why everybody is waiting for the next New Zealand Central Bank meeting and see what kind of language they will use at the interview afterwards. From a technical perspective, we can see that we had a big move. If you remember, we had a post explaining why we were shorting the New Zealand dollar against the US dollar, and that was based on the price of milk and other economic indicators. Let me show you now another chart that we are using in our analysis and something that we are teaching in the course. Now, you might be wondering, what is this? This is the New Zealand dollar against the United States dollar. This is another form of charting prices, and this is called a market profile chart. This is something that we are teaching in the course, and it is giving us a better edge instead of using traditional technical analysis only. We will explain in detail what is a market profile chart. What you need to know now is that market profile chart is just like any other chart, like a bar chart, a line chart, a candlestick. But what is different is that in a market profile chart, time is moving vertically and not horizontally. What we also try to achieve by using a market profile chart is see where we have large concentration of prices. We will go into details in the course, but right now, let me explain what you see on this chart on the Kiwi. So, if you remember last week, we had a post where we explained why we were shorting the New Zealand dollar. We were doing this based on fundamentals, and also because if you look at this market profile chart, you see this high volume node over here. This is a large concentration of prices, And what we noticed is that we were moving below this. So our entry was here, just below breaking the high volume node. And you see that the market moved down as we had expected. Where was our target? Let me show you quickly how we use. So if that was our entry and that was our stop, you can see here our entry, our stop loss, and what we are trying to do is we are trying to get at least 2 times our risk or 3 times our risk. Now, if I look at this chart, you see that the New Zealand dollar is bouncing from the top of previous weeks. You can see this here. I'm just moving my cursor so you will notice which area I'm talking about. It is moving higher, it is retracing, but look, when we found this high volume node and the value area low, the value area is an area where we have 70% of the volume happening. So look what happens when we find this bottom of the area. You see, this is resistance. So our outlook for the New Zealand dollar hasn't changed. So we will be looking again to sell at this level, or if it moves higher, at this level, which is more important. This is a more important resistance. This level is 0.8620. This is very important resistance, and the other area is around 0.8550. So you can clearly see the benefits of using something like this instead of traditional technical analysis. And we apply this kind of analysis for all our currency pairs, for indices, commodities, anything. But as we have explained, we are not only looking at the technicals, even if it is market profile. What we are waiting for is interest rate decision about the Kiwi, and most importantly, the language that we are going to use. Now, there is another currency that we are paying close attention this week, and this is the Aussie dollar. Now, we have made a list of factors that will affect the Australian dollar, and this is Australian and Chinese economic data. Australian, okay, you can understand why we are paying attention to Australian economic indicators, but you might wonder why we are looking at Chinese economic indicators. One of the things that we are teaching in the course, and is part also of our analysis and the way we run our funds, is intermarket relationships and correlations. You see, Australia as an economy is heavily dependent from what happens in China. China is a big engine of growth for Australia. So this is why we have to look at both economies before deciding what we are going to do about the Aussie dollar. So we are looking at Australian, Chinese economic data, and then the next thing we are looking at is expectations again for a rate hike from the Bank of Australia. So far, everyone was expecting that we will have a rate hike in Australia because obviously the economy was doing very well, and you can see this from the beginning of the year. This was priced in the prices because we had expectations of higher interest rates, and because the Aussie dollar is highly correlated to US indices, I mean the equity markets, we had a big run-up. What happens right now is that the Australian Central Bank is downplaying expectations about an interest rate hike. Are we going to move to a period of stable interest rate outlook? What kind of language they are going to use? This is something to be seen, and we are very carefully investigating this angle. Another thing that we are paying very close attention, of course, is what happens with the United States. A strong US economy and signs of ending the stimulus will hurt the Aussie dollar. So you see, what we are showing to our students is learning how to do intermarket analysis, how to look at correlations. we are showing them what factors are affecting the currencies, so we are able to understand the structure of the market, how each indicator is affecting some other market, how markets interact between them. And in this way, we are able to understand where is the opportunity, where is our reward, and where is our risk. So by looking at the Aussie, you can see that it is no longer in a trending phase, it is moving sideways, it is inside the triangular pattern, you can see here the trend lines, and we are very carefully examining the fundamentals before we decide in which direction is the Aussie going to head. This is it for me. I don't know, Mark, if we have something to discuss.
Well, before we go on to Judith, just looking at the Aussie dollar, so basically we're bouncing between 92 and the upper line is going to be around 94. Can you explain to students in terms of we're looking for a reversal back down, or we're looking for a breakout, or we're looking for either or?
Yes, you can see one level of support is 92.10. I would say this is the bottom. Then we have the top of the trend line, which is around, yes, you were very correct, it's around the 94 level.
Mm-hmm.
We are not simply just waiting to play the breakout. What we are looking for is fundamentals. For example, we might reach the upper trend line. You can see the level, yeah, it's around 93, 97, 94, let's call it a round number. I'm looking to see what happens with the United States indices. I'm looking at S&P. S&P is one of the most important sentiment indicators for me. If I see equities moving down, then definitely I'm going to short the Australian dollar. Because what we teach in the course is about risk on, risk off. That means that if we are in an environment and the sentiment is negative, we know precisely at which currencies to look at. So we are not simply waiting to trade the breakout. For example, if it breaks this trend line or if it breaks that trend line. Because many times we also have false breakouts. We are waiting to see what will happen with the fundamentals, and then we will use technicals as our trigger, mostly to monitor our risk and our reward. And as I have explained before, we are not only looking at this kind of charts. I will go to our market profile chart and determine where is our risk and where is our reward by looking at important areas such as high volume nodes, low volume areas, things like this.
Okay, right. We're now going to pass you over to Judith. Judith is one of our students who joined us last week. She's had a few sessions with Fotis already, and she says herself she's suddenly changed the way she's looking at the charts now. Instead of just technically trading, she's now applying fundamentals. And Fotis set her some homework for the weekend, and that was to analyse what had happened last week after Draghi, after NFP, and her projections for the week ahead and the pairs that she's going to concentrate on. And then we'll have a little critique at the end of it and a Q&A session with Judith as well. Over to you, Judith.